Welcome to Spring Into ETF Investing. On today's special episode, our panel of guest speakers will be discussing satellite ETFs to strengthen your portfolio.
Welcome to Spring Into ETF Investing, a special edition of ETF Market Insights. I'm Erin Allen, VP of Online Distribution with BMO ETFs. Quick reminder, today we are not providing you investment advice or recommendations. Our channel is all about providing education around investing and around ETFs focused on the Canadian do-it-yourself investor. I'm going to turn over my hosting duties to Jessica Morehouse shortly. Jessica is a personal finance expert and an accredited financial counselor. She's also the host of the popular More Money podcast, and I'm excited to have her on our channel today. So Jessica, over to you.
Welcome to ETF Market Insights. I'm Jessica Morehouse. Today, we're going to be talking about how to build a portfolio using ETFs, and specifically, we're going to focus on how satellite positions can be used as a complement to strengthen your portfolio by adding greater diversification. I'm pleased to be joined by Alfred Lee, Director, Portfolio Manager, and Investment Strategist at BMO ETFs, and Andreas Rincon, Director at TD Capital Markets. His ETF team advises both institutional and wealth investors on the ETF landscape and strategies, and publishes a broad array of ETF publications, and works with TD's ETF market making team in facilitating ETF orders. And I'm really looking forward to our discussion today. Welcome. So, Alfred, I want to start with you. When we talk about portfolio construction, I think a very popular strategy that a lot of people, want to know more about and talk about is the core satellite approach. Did you want to kind of dive into what does that look like? What does that mean for investors?
For sure. A core satellite strategy originally came from the institutional side of the business. So, to me, it's a really structured way of outperforming the market, but also controlling the fees in the portfolio. So, there's many different variations in which you could put together a core satellite strategy, but most iterations essentially involve a low-cost index-based ETF in order to make up the core of the portfolio. And the reason why is because you can get a low-cost index ETF that tracks the TSX, for example, for 6 basis points, ZCN, for example. You could also get exposure to the S&P 500 for only 8 basis points. So that's a good way to tie a majority of your portfolio to a low-cost index product. The remaining portfolio you can allocate to an active manager, you can allocate to individual stocks or sector or thematic-based ETFs. But when you look at it statistically, so when you look at reports like SPIVA, for example, which is the S&P index versus active report, what you'll find is that active managers have had a tendency to, had a difficult time in outperforming the index over the long term. So when you look at a core satellite strategy, by anchoring, let's say, 80% of your portfolio to an index, that guarantees you market-like returns for the majority of your portfolio, low-cost indexing, also diversification, but then the remaining 20%, what you could do is allocate to an active manager, or if you want to be a little bit more hands-on, you could allocate to a sector or thematic-based ETF. And we've also seen some investors that want to be really hands-on, they could pick their individual stocks and pick stocks that can potentially outperform the market.
No, absolutely. Now, Andreas, I want to go to you. Why would an investor want to consider this approach?
And first and foremost, thank you for having me. Appreciate it. I think the main idea or the main goal is to have a plan. What we see a lot of advisors in mom and pop dudes, that they'll buy a bunch of different ETFs and they'll end up with a soup of ETFs and a soup of different stocks within the ETFs and bonds and whatnot. And often what they don't really understand is what they hold. How much do they hold of technology? How much do they hold of this factor? How much do they hold of a certain stock even? They might have this same stock replicated across different ETFs and they might not even know it. So it's all really about having a plan. And that's where the satellite core strategy comes in. As Alfred was mentioning, it originated actually from the efficient market theory. So two Americans were looking at it and saying, okay, I don't think you can beat core. I don't think you can beat index products. And we'll talk a little bit about that. But then, so how do you actually beat it? And one of the ways they found to beat it is, look, we can have most of our assets in core, low cost, efficient and whatnot, and then a little bit here and there to generate that alpha. And that's what we've seen a lot of the push there towards those products. If you get into the two different areas, some of the benefits, like if you look at core specifically, well, you get diversification. In one single ticket, which is generally very low cost, you're going to get exposure to a variety of securities globally, locally, and different asset classes. So it's a very easy way to get exposure to the market. You also have, tends to be tax efficient, tends to have a lot less turnover. So we see a lot of benefits in using the ETF vehicle and an index product for that specifically. And most importantly, like, it's a low cost. It's amongst the lowest cost products in the market, and you're buying this on a big portion of your portfolio. So you're minimizing the cost to the broad portfolio that you have. And if you get into the satellite ones, really here's where, as Alfred mentioned, here's where you generate your alpha. You find satellite positions that you can tag on to your portfolio. And actually, what it really does is further diversifies your portfolio, because these core strategies might have, certain exposures here and there, or might not have some areas. And this is where you tag on with core strategies. And sometimes they can't necessarily be that expensive, but they don't move the average cost of the portfolio as much. So it's a very common way to invest, and is one of the big benefits of that strategy. So once again, going back to the original comment, is one easy way to diversify and not have a soup of strategies and know what you're actually investing in.
Absolutely. Now, Alfred, let's talk more specifically about satellites. What makes a good satellite, in companion with your core portfolio?
So I think it really depends on what the investor is looking for. So it could be one of three things. So usually an investor could be looking for returns above and beyond the market. So for example, a satellite portion of your portfolio, you can allocate to an active manager through an ETF or a mutual fund in order to get those potential outperformance. Again, if you want to be a little bit more hands-on, you could allocate to sectors or themes that you think are going to outperform. Very similarly, if you want to allocate to individual stocks, you can pick your own stocks for that satellite portion. I would say the other reason, or another thing that a lot of investors are looking for when it comes to satellites, is reducing the risk in a portfolio. So that satellite portion could be allocated to sectors or themes that tend to be less risky than the market, or individual stocks that tend to be more defensive as well. So things like utilities, for example, or consumer staples, or infrastructure stocks, those are good examples in which you could reduce risk in a portfolio. The third purpose of satellite, I would say, is uncorrelated assets. So we've seen a lot of people more interested in uncorrelated assets, especially after 2022. So as central banks were raising rates, bonds and stocks fell together in 2022. So a lot of people have become interested in assets that are less correlated to traditional stocks and bonds in order to get proper diversification. So we've seen a lot of interest in things like gold, listed infrastructure, things like listed agriculture commodities, even long-short strategies. So it really depends on what the investor is looking for. So it could be additional returns above and beyond the market, risk reduction, uncorrelated assets, or it could be a combination of the three.
One thing that I would like to add to that is that a lot of people think of core just like pure equity only. And core can be a balanced portfolio. That's basically the core part of your portfolio. It's important to remember that, as you just mentioned, there's been a lot of changes with the mix in assets and the willingness to have a 60-40 or whatnot. But it's important to understand the core just means the most important part of your portfolio.
Absolutely. Very important to remember. Now, Andreas, I want to talk about some specific examples. Can you walk us through how sector ETFs can be used and some different sectors that might be attractive given today's market environment?
For sure. I like to think about it this way. Like most people, once again, think about core as, let's say, equity. So let's say you're looking at the S&P 500. Most people don't realize that when you're investing in the S&P 500, you're investing in 30% of that exposure is in either semiconductors or some technology-related business. So they're fairly technology heavy in that respect. So one way to diversify away from being technology heavy in the S&P 500 is to buy Use Sector ETFs on areas that are not really highly exposed in the S&P 500, let's say. So utilities were mentioned earlier as a great area. One of the areas that we see quite often is real assets, infrastructure. These are areas where we're seeing a lot of demand because it's not really well represented within broad indices that well. And these are areas that tend to have low correlation, low volatility. So very, very, very common. You can say the exact same thing about Canada. Canada's broad index is very much bank-centric. And if you invest in a core that is fairly bank-centric, you're well to do to buy some satellites that kind of diversify further that exposure into other areas. Let's say gold. You might buy a gold ETF, or you might buy something along those lines that complements what you have in Canada. So that's one of the main ways that we see the implementation when it comes to equity specifically.
No, absolutely. So Alfred, I know factor ETFs like dividends and value and low volatility, those all can help to tilt a portfolio. Can you discuss some examples of how this would work?
Sure. So I think before I do so, I think it's a good idea just to highlight what factor-based ETFs are. So as you mentioned, there's factor-based ETFs that target equities that have certain characteristics. So dividends, as you mentioned, is a good one. There's also low volatility, value, momentum, so on and so forth. But I think, 15 years ago, when you looked at the ETF industry, it was really made up of market cap weighted ETFs, meaning that those ETFs essentially had, larger companies making up a higher weighting in those ETFs. I think a lot of investors realize that investing is not a one-size-fits-all strategy. So some people may want less risk. Some people may want more dividends, so on and so forth. So that's where factor-based ETFs come in. But I would say, when it comes to core satellite investing with factor-based ETFs, they're unique in the way that they could be used for both the core or the satellite as well. So for the core position of a portfolio, for example, again, if you felt that, let's say, Canadian equity index ETF doesn't have enough dividends, you can use a dividend-based ETF as a replacement for that ETF. For the satellite position, let's say if you go back to the plain vanilla of core satellites investing, if you're using an index-based ETF for that core, you can use a low volatility ETF as that satellite to bring down the risk, for example. But we've also seen a lot of investors that have a lot of technical know-how, want to be involved in their own, managing their portfolio on a day-to-day basis. They've been using factor-based ETFs more tactically, so rotating depending on what market environment we're in. So, I think factor-based ETFs are unique in the way that they could be used for both the core and the satellite position of a portfolio.
Absolutely. And Andreas, I want to kind of talk to you about what are some examples of these satellites. I know there's, commodities and emerging markets. Do you want to kind of speak to that a little bit more?
Yeah, how I like to separate them is in several groups, basically. So we already talked about factors. We already talked about sectors. I also look at them from an asset class perspective. I also look at them from a region perspective. And I have a little bucket called specialty. We already talked about factor and sector, so I'm not going to touch too much on those. But let's say the asset class ones. So most people just think about equities and think about fixed income, but also there's commodities, right? And it's very important to understand that that's another asset class and the benefits of those asset classes and the diversification benefits of introducing a commodity or introducing something along those lines. Then you have what I consider a separate asset class, which are covered calls, let's say. So if you want a yield-centric product, then why not use one of these products too? So those are, you can consider those separate asset classes that you can tag along as satellites to your core. Then you have regions, emerging markets, Asia specifically, Latin America, you want Europe. There's many ways that you can get exposure to the world, and it doesn't have to be part of your core. It can be part of your satellite. So let's say that there's a lot of growth in Asia, so you can buy an Asia-focused ETF, and that's one of the most common ways we see these days. And there's very easy ways to get cheap exposure to countries specifically. And then the last one is the specialty one is, look, there's many areas of the markets where these securities or these areas will fall between the cracks, like the preferred share markets or I mentioned again, covered calls, liquid alts, alternative strategies. These are very important strategies that are generally very different to your existing core and will add value in terms of diversification, differences in returns and whatnot. So those are the three main areas how I split or the five, I guess, if we include the factor and sector, how I split the satellite world.
So you just mentioned liquid alts. Alfred, did you want to kind of expand on that for anyone who isn't super familiar? What's a liquid alt? What does that mean?
Sure. So liquid alt is essentially, I talked about alternatives and assets that don't typically fit into that traditional 60-40 bucket. So isn't quite equities, but isn't quite fixed income as well. So liquid alts essentially are that separate bucket. So it's alternatives, but it also has usually daily liquidity as well. The good thing is that with a lot of the changes in the regulation, ETFs now can provide exposure to liquid alts, so things like long-short strategies, which I mentioned. I think in an environment like 2022, as I mentioned, when bonds and equities are falling together, that exposure to liquid alts is going to help you get better diversification in a portfolio.
Well, thank you, Alfred. Thank you, Andres, for joining me. It was a pleasure. It is so great how much flexibility ETFs provide investors when it comes to portfolio construction. Being able to tilt your portfolio to certain areas where you have conviction has been made that much more accessible to DIY investors with ETFs. Well, that covers our discussion today. Thank you again both for joining me and bringing such great insights in today's session around building a portfolio of ETFs and using satellite exposures to tilt your portfolio depending on your market views. A very interesting discussion. And thanks to BMO ETFs for continuing to host these educational segments for DIY investors. I'm Jessica Morehouse. Have a great day.